The International Labour Organization cuts its global employment forecast for job growth this year to 1.5%. German unemployment surges faster than expected in May. And US business spending softens as tariffs uncertainty persists. Welcome back. You are watching the Qnews Economic Bulletin. I'm Hani Saif, and we start off with the International Labour Organization that has cut its global employment forecast for job growth this year to 1.5% due to a worsening global economic outlook and trade tensions. ILO reported that some 53 million jobs will be created this year. That is 7 million less than previously thought, as economic growth predictions were lowered to 2.8% from 3.2%. It added that some of the 84 million jobs across 71 countries that are linked to US consumer demand are increasingly at risk of disruption due to trade tensions, and that Canada and Mexico have the highest share of jobs exposed. The ILO Director General, Gilbert F. Hungbo, further highlighted that failing to address ongoing geopolitical tensions, trade disruptions, and fundamental shifts in the world of work will harm global labor markets. The European Central Bank has reported that Eurozone consumers raised their inflation expectations in April, but kept a steady view on price growth further out, highlighting elevated uncertainty amid a global trade war. The ECB's Consumer Expectations Survey showed that households see inflation at 3.1% over the next year, above the 2.9% predicted a month earlier and also well above the bank's 2% own target. It added that inflation expectations 3 and 5 years out remained unchanged, while consumers see price growth at 2.5% in 3 years and at 2.1% in 5 years. Unemployment expectations for the next 12 months rose to 10.5% from 10.4% in March, while economic growth forecasts declined, with estimates indicating the economy will shrink by 1.9% during the same period, down from the previously forecast 1.2%. The European Central Bank has stated that Christine Lagarde is determined to complete her 8-year term as president, in response to the Financial Times report claiming that she held talks about leaving early to lead the World Economic Forum. The ECB spokesperson highlighted that President Lagarde has always been fully committed to deliver on her mission and is determined to complete her term. The National Employment Agency has reported that the number of people out of work in Germany rose at a faster pace than expected in May, putting pressure on the government battling to wrench Europe's largest economy from a prolonged downturn. The monthly increase, which came to 34,000 in seasonally adjusted terms, was significantly higher than the 10,000 expected. German Labour Minister Bärbel Baas highlighted that the current labour market figures show the urgent need of economic policy impulses that create growth. The German Defense Ministry has announced that it will provide further military support for Ukraine, amounting to around €5 billion. The ministry added that the aid will be financed by funds already approved by Germany's lower house of parliament. German Chancellor Friedrich Merz also stated that during a visit of Ukrainian President Volodymyr Zelensky to Berlin, that both countries will develop the joint production of long-range missiles without range limitation. The Bank of Spain has warned that lenders' income growth was likely to slow down this year amid lower interest rates and geopolitical risks, and it would need to closely monitor the credit quality of bank loans. The central bank stated that the credit quality was now at favorable levels, but it could deteriorate if a potential economic slowdown weighs on borrowers. It also said the much-delayed implementation of the Basel III International Capital rules remained a priority, as it would prevent accumulation of global systemic risks. The bank added that the rules should be consistent with the planned revision of the European Union's supervisory framework to make the framework simpler without undermining the bank's resilience. France and Indonesia have signed a preliminary defense pact that could lead to new orders of military equipment from Paris. French President Emmanuel Macron stated the deal included Rafale fighter jets and Scorpion submarines. The two countries also signed a host of other memorandums of understanding, including one on cooperation between French mining company Hermet and newly established Indonesian sovereign wealth fund Dana Matra. Australian Bureau of Statistics has revealed that consumer inflation held steady in April as higher health and holiday costs offset a drop in petrol prices. Although the monthly measure tends to be volatile and let hopes for more interest rates cut mostly intact. Data showed the monthly consumer price index rose 2.4% in April compared with a year earlier. The trimmed mean measure of core inflation increased by an annual rate of 2.8% in April from 2.7% in March. A measure excluding volatile items and holiday travel also picked up to 2.8% from 2.6%. The Japanese Fiscal System Council has compiled opinions, including calls for urgently securing fiscal space in response to external factors such as the Trump tariffs. The Council submitted the opinions to the Finance Ministry and expected opinions to be used as references when the government puts together its basic policy on economic and fiscal management and reform in June. It added that securing fiscal capacity is an urgent task to deal with additional potential external shocks, including natural disasters. The Council also urged the government to aim to bring the primary balance back to a surplus as soon as possible during the current and next fiscal year through March 2027. President Donald Trump stated that the U.S. government will retain its mortgage guarantees and oversight role of Fannie Mae and Freddie Mac as the works to take the U.S. mortgage finance firms public. In a post on Truth Social, Trump highlighted that he's working on taking these amazing companies public, but he wants to be clear. The government will keep its implicit guarantees, and he will stay strong in his position on overseeing them as president. Trump added that these agencies are now doing very well, and the U.S. Treasury owns preferred shares in the firms and warrants to purchase about 80% of their common stock. The Department of Commerce reported that new orders for key U.S. manufactured capital goods plunged by the most in 6 months in April, amid mounting uncertainty over the economy because of tariffs, suggesting business spending on equipment weakened at the start of the second quarter. No defense capital goods orders, excluding aircraft, tumbled 1.3% last month, the largest drop since last October. Core capital goods shipments slipped 0.1% after increasing 0.5% in March. Non-defense capital goods orders slumped 19.1%. Shipments of these goods rebounded 3.5% after falling 1.1% in March. Federal Reserve Bank of Minneapolis President Neel Kashkari has called for keeping interest rates steady until there is more clarity on how higher tariffs affect inflation. He also warned against looking through the impact of such supply price shocks. Kashkari added that in an ongoing healthy debate within the Fed, some policymakers have called for looking through the impact of tariffs as a transitory inflation shock, thereby prioritizing support for economic growth by cutting interest rates. He further stated with U.S. inflation having well exceeded the Fed's 2% target for 4 years, there were concerns as to how long-run inflation expectations can avoid de-anchoring. An International Monetary Fund team has reported significant progress in Egypt's efforts to stabilize its economy under the Extended Fund Facility. Led by IMF Mission Chief Ivana Vladkova-Ola, the team held talks in Cairo from May 6th to the 18th. The IMF has raised Egypt's economic growth projection for the fiscal year 2024-2025 to 3.8%. citing stronger than expected performance during the first half of the fiscal year. The fund also praised Egypt's efforts to modernize its tax and customs systems, promote fiscal discipline, and reduce the state's economic footprint. Talks will continue virtually to finalize the policy framework required to complete the fifth review. The European Union and the United Arab Emirates have officially launched negotiations for a comprehensive free trade agreement, the first of its kind between the EU and a Gulf country. Talks were initiated on April 10th during a meeting between European Commission President Ursula von der Leyen and UAE President Sheikh Mohammed bin Zayed Al Nahyan. The move was confirmed today in Dubai by EU Trade Commissioner Maros Sfikovic and UAE Minister Thani bin Ahmed Al Zayudi. A deal aims to reduce tariffs, ease service trade and investment, and foster collaboration in sectors like renewable energy, artificial intelligence, healthcare, and critical raw materials. The first negotiation round begins in June, with bilateral trade in goods at 55 billion euros and services at 39 billion euros annually. The UAE is the European Union's top trading partner in the Gulf. Saudi Minister of Foreign Affairs Prince Faisal bin Farhan has highlighted the vast potential of partnership between the countries of the Gulf Cooperation Council and Association of Southeast Asian nations. He emphasized the importance of intensifying efforts to facilitate trade and remove any barriers. Bin Farhan also highlighted the significant growth in trade between the two groups, noting a 21% increase from 2023 to 2024, bringing the total trade volume to approximately $123 billion in 2024. The government of the state of Qatar has signed an agreement with its Palestinian counterpart to enhance mutual cooperation in the fields of labor and to regulate the recruitment of workers from the state of Palestine. The agreement aims to support the Ministry of Labor's strategy to attract skilled and qualified workers, strengthen their presence in the local labor market, improve private sector productivity, and advance the work environment. Under the agreement, both parties will facilitate the recruitment procedures for skilled labor from the state of Palestine and supply the local market with the required expertise. Additionally, they will review available job opportunities in the state of Qatar and explore their availability in the state of Palestine to benefit from them. Bank of Israel Governor Amira Yaron has stated that another 6 months of war in Gaza would reduce Israel's economic growth by a half point in 2025 and a further raise the debt burden. Yaron added that monetary policy needs to remain cautious given the uncertain geopolitical situation and near-term inflation environment, with policymakers ready to delay any rate cuts until inflation eases. He expressed fear of prolonged inflation due to war-constrained supply and imbalanced demand. Yaron further noted that if inflation persists without corrections, restrictive interest rates will continue for longer and that a sustained appreciation of the shekel, however, would help mitigate this inflationary pressure. The Israeli Occupation Army has said it confiscated approximately $2 million during a series of raids on money exchange shops in the West Bank, which left at least one Palestinian dead and more than 30 injured. The military operation carried out on Tuesday also resulted in the arrest of 30 individuals. The army claimed the targeted exchanges were suspected of financing terrorism, though no specific evidence has been publicly presented. For further analysis, we are joined from Cairo by Mr. Abu Bakr Deeb, the advisor and researcher in political economy, the Arab Center for Studies. Mr. Deeb, thank you and welcome to Q News Economic Bulletin. Sir, how bad would an additional 6 months of war in Gaza affect Israel's economy?
Good evening to you and to the viewers. More than 600 days of war which weakened the Israeli economy significantly. The first initiative launched by Netanyahu affected the Israeli economy. A lot of activities in Israel are very harmed by this war, and if the war continues, the harm will be further. The agricultural sector is suffering, especially after the immigration of labor, whether from Palestine or from abroad, who used to work in the Israeli agricultural sector. Also, the agriculture in the settlements surrounding Gaza are completely suspended. Also, the technology sector, which was an added value to the Israeli economy and represented around 20% of the Israeli exports, which was a huge percentage of the GDP, was also significantly affected, as all the Israeli sectors are very busy with the war. The exports and imports are very impacted. Also, the tourism sector is completely suspended and paralyzed. The percentages and the figures indicate that the world is avoiding Israel, and there is a large volume of immigration from the Israeli people, which is pushing the Israeli institutions to reconsider the current situation. There's also a huge financial deficit and budget deficit. The general debt, the public debt level can jump to 75% of the GDP if the war continues. The war is very costly also for the recruits who are coming from all of the sectors and backgrounds from education, agriculture, leaving their companies or jobs behind to go to war, which is very costly for the government and for the state. As they lose their job and these jobs are suspended and left without labor, also spending around 2,000 shekels a day per recruit in the Israeli army. So it's a very high price. Also, that displaced inside Israel who are living now in Tel Aviv or the suburbs, either in hotels or resorts that was initially prepared for the tourists. They are living on the state expense. Also, the reparations are affecting the all sectors, the energy, the real estate, all sectors are significantly impacted by the war. The inflation rates are high, the interest rates are rising, and the Central Bank of Israel is not able to lower the interest rates given the high inflation rates.
Well,
And
sir, could cautious monetary policy and delayed rate cuts deepen the economic stagnation?
of course, increasing the interest rates means deepening the economic stagnation, because Israel will not be able to lower the interest rates as the inflation rates are very high, so they are not able to lower the interest rate to serve the investors and push the production wheel forward in Israel. The interest rates remain very high to attract any investors, and therefore we are seeing a recession in the industrial sector inside Israel, given the inability of investors to gain and obtain any funds from the banks due to high interest rates. Also, the Israeli international reputation, economy-wise, and the credit ratings, the poor tourism and investment sectors, and the immigration of different companies from Israel to more secure and stable countries such as the United Arab Emirates or Egypt or Saudi Arabia. These companies leaving Israel, and it used to be based in Israel and working independently there. Now they are afraid of all the disruptions and tensions, as the war has taken so long, which led to the deteriorating Israeli economy.
Mr. Adib, now, with the prolonging of the war, will also Ben Gurion Airport's Terminal 1 closure deepen the economic downturn? Will it have a significant effect?
The airport in any state is the theme of security, stability, and sovereignty for any state. The Ben Gurion Airport was the largest and most official airport in Israel. And therefore, if it's suspended or the operations are disrupted, and it was disrupted more than once recently, it means instability in Israel. As I have said, it is the main theme for any tourist, for any investor, for any capital to be attracted into Israel. And if it gets disrupted, it means instability and the lack of security inside the Israeli state. We have seen several aviation companies canceling their trips in and out of Tel Aviv, and
Yes.
which is leading to a very negative portrayal of the Israeli economic situation for investment or for the tourism sectors around the world. And it's a very important indicator. The airport, the seaports, all of these sovereign titles of any state, if they are disrupted or suspended, it means affecting the entire economy. And Ben Gurion airport was targeted several times by the Houthi, and it was suspended for hours.
Yes, definitely. Well, from London, that was Mr. Abu Bakr Adib, the advisor and researcher in the political economy, the Arab Center for Studies. Thank you very much, sir, for your insights. And these were all the economic news we have for now. And here's a reminder of today's main economic stories. The International Labour Organization cut its global employment forecast for job growth this year to 1.5%. German unemployment surges faster than expected in May. And US business spending softens as tariffs uncertainty persists. By this, we come to the end of our economic news bulletin, but please don't forget to follow Q News on YouTube, Facebook, X, Instagram, and TikTok at Qnews EGY to stay informed. I'm Henny Saif. Thank you for joining us.